So today we are going to be talking about the gamma aspect of markets. We're going to be talking about two specific new tools which we added to our arsenal. And to understand them better, we are going to be doing this session today. Your questions are welcome. And what you would expect by the end of this session is to know exactly what the pros, the big money of the market is doing, where their positions are, and how they keep adjusting to the new information which the market is giving in. I'm going to be walking you through a whole bunch of terms and could be new to some of you, and some of these terms would be things like density and convexity, etc., which is needed, which is important, okay, and needed to understand how the market operates. But hopefully I'll try to keep it as simple as possible, and if there are some things which still do not make a lot of sense to you, please feel free to use the chat box and ask questions. I'm reading you as I go along. Right, so it's about gamma density and gamma exposure today, and the idea over here is to level up our Nifty settlement day experience, get better at trading what we call the weekly and the monthly settlements. So if you never heard these terms before of delta, gamma, exposure, convexity, I hope by the end of it you will become extremely familiar, because these are some terms which professional money uses day in, day out as they trade options. And I do hope, okay, by the end of this session that these things, okay, become absolutely clear to you, right? So before I begin, I just wanted to again brief about what delta is and what gamma is. And it's important to make a distinction between trading derivatives and trading the broader equity markets. You know, I was also a very new trader once in a while, and the mistake I did as a very brand new derivatives trader was to think about the derivatives market exactly like the way I spoke about in terms of equity markets, and to think about everything which was moving on screen in terms of price, and treating derivatives like equity. That was a fundamental mistake I did as a derivatives trader very early to the business of derivatives, and I failed in markets. I did not understand that derivatives was more complex. It had not every single thing to do with the price action. There was a whole lot of other things which went beyond knowing the role of price. And once I got deep, once I understood what derivatives was how I understood the derivatives market model was based on, I got a different set of results out of these sessions, these derivative classes. So as newbie traders, we think about everything in terms of, you know, that linear equation. Price moves, derivatives price should also move, and we tend to think of it as a 1:1 equation. That's not true. Derivative markets are more complex than simple equity stock only based markets, and we need to make a little bit more in terms of effort to understand the derivatives market better. So I'm not going to go much into all of that, but as derivative traders, we need to have a fundamental understanding about what delta is and what gamma is. So that's the topic of what we are going to be speaking about. And the delta is nothing but you driving on a highway, and the pace at which you drive, that is your delta, right? A lot of newbie traders, what they do is they expect market to move, and even if the market moves and works in their favor, they do not capitalize on the maximum potential of the move because they have not understood what delta of the option to buy. So for example, you're going, okay, on a highway where the speed limit is about 120, and you're cruising at a speed of 20, you will take a lot more time to reach your destination. In short, what you've done is on that expressway where that limit was about 120 kilometers per hour, you're driving at a delta of 20 kilometers per hour. So the net result is you're going to reach your destination slower. The same thing happens to us when we trade in options. We fail to take into account the delta pricing of the option which we are looking at. And what I highly recommend is everyone, okay, should look at the delta of the option which you're looking at. So you can quickly, before you take a position, look at the Greeks of the chart. And this is the Greek chart which we have. and all of you, I'm sure, are very familiar with it. But one of the more important parameters over here is this word D, which tells you how much the market is going to move with respect to every 1 rupee move in that instrument. Uh, if you are expecting a big move in the markets, you've got to choose something which has got a higher delta. And technically speaking, okay, that if you are long bias in the market and say the market is around 24,400 and you're expecting the market to go to about 24,700, you'll be better served by choosing an option which is trading with a delta of 0.55 or 0.65, because that 200 point visualization which you have is going to come out much more neater for you. Whereas if you choose something which is, when the market is 24,400 and you choose a delta of 0.20, say somewhere around 24,700, you will still make money, but not as much as you would if you choose a delta of 0.65 or 0.75. So a simple rule, when you're choosing options, choose options with higher delta. And if you're choosing to get to higher delta, you don't even need to look at this Greeks table. If the instrument is trading around, if the market is trading around 24,500, for example, and you're expecting the market to move to 24,700 as it did today, you are expecting it and your bias is strong for that move of 200 points, we would recommend, instead of you trading that with a 24,700 call, which you can do, you can trade it with a 24,400 call or a 24,300 call. Okay, not even that 24,500 in the money, at the money call option. The reason is because that 24,500 call and the 24,400 call being in the money have got a delta of 0.65, and that delta means that for that 200 point move, you're gonna get about 65 points per 100 points, 130 point move in that option which you trade. Whereas if you take that same 0.25 out of the money call for that 200 point move, you may be making about 20 or 40 points from it, right? So this is explained clearly in a lot of tutorials, a lot of notebooks. They explain which delta to take, which option to take. So that is fundamental. That is beyond basics, and you need to have a clear idea about what delta is. So to put it as a clean summary, delta is the speed at which you have moving about on your highway. It's like your car's speedometer. It tells you your current velocity, and as you go and the market is moving, it tells you, okay, what your current movement is, right? Now that is delta. What we're going to be focusing on today is another aspect of the market, which is called gamma. Now, if delta is the speedometer of your car, it's the velocity of your car. Gamma is about how responsive your accelerator pedal is. Gamma is the pace of the market. It's the rate of change of delta. It's the acceleration power which is there in your engine, right? So some of these cars you look at, from your Maruti to your BMW, that accelerator pedal works differently. Different engines have got different tunings. The pedals work differently. Simply put, the better the pedal, the accelerator pedal, the more is the acceleration which you can get from that car. And that, okay, makes a lot of difference, especially in markets which tend to move very fast, both up and down. An example of this being at play is today. If you looked at how the market behaved via the long puts in the morning and the long calls in the afternoon, that's an example of how gamma changes every single day. So if delta is the speedometer of your car, gamma is the accelerator pedal, and together delta and gamma have a large role to play about in the options market. Now, as newbie traders, people who are newly exposed to the world of derivative tradings, we are exposed to terms like open interest, we are exposed to terms like theta, we are exposed to some of the other things, okay, which are in the first order Greeks. But the actual movement, especially on settlement day, comes through these second order Greeks, and some of them, okay, are your gamma and your rho, etc., etc. we're going to be focusing on the role which gamma plays and how this is important for us going forward. Right now, we talk in terms of two aspects of gamma, and these are absolute fundamentals. We talk of the market in terms of a long gamma market and in terms of a short gamma market, and this is represented by this chart. Now, why is this important? Because if you look at how the market is positioned, and this is an open interest positioning of the market. In the India market, you really don't have a lot of market makers. You don't have in the US market. What they do is there is always a buffer between a buyer and a seller. A large institution, or what we call a market maker, comes in and sets the pace between the buy orders and sell orders. So if there isn't a lot of liquidity in the market, the market maker comes in, he absorbs that order, and he later sells that order to another party at a time and price of his choosing. That does not work in the India markets. In the India markets, the dominant players are your pros and your clients. And not to say that one is weak and the other is strong, but what they do is they sell to each other or they trade with each other. So if you look at this chart which is on screen, you will see that the FIs have started working a lot into the options market. They were always those equity kind of traders, and now for the past many years they've been moving away from equity and coming and making a bigger presence in the options market. But their positions are basically to hedge their equity exposure, and some of these trades which you see by FIs are in the longer duration monthly contract. The weekly contract which you and I trade out of is dominated by pros and clients. So the DII is almost absent. You will see zeros, and they are actually not trading much in the FNO markets today. But the pros and the clients trade with each other, and depending on how they see the market, they take both long side positions as well as short side positions. So there is this misunderstanding in the market that pros are always taking short calls and shorting the markets via right side trades, shorting calls, shorting puts, etc. That's not always true. They have both long puts, short calls, long calls, and short puts at trade in the market. Okay, at every single point, depending on how they view the market and what they expect the market to do next, they keep adjusting their positions. Same goes with clients. Clients are also long calls, short calls, long puts, and short puts in the market. So it's not enough to know that everybody is short call, short options in the market at all times. There is a assumption made, and it's a wrong assumption made, that all the open interest which is built up at a particular strike is all short open interest. It may be true in some cases, but it's not true in all cases. And this particular chart over here will tell you that people buy calls. This is all long calls. People short calls. People buy long puts, and people buy short puts. So we move away from what the market thinks, that everything on a strike is short options and everything which is there on a particular strike in terms of open interest is short open interest at work in that thing. So you'll see over here that the market sometimes it's got long contracts open and short contracts open, right? Now this is number one. Number two, many times you will see that what pros and what clients hold are inverse of each other. So if pros, for example, yesterday they went into the market net short call options, you will see clients had gone into the market net long call options. Now this is not a statement on whose bias was right or who got on the wrong end of the trade. This is a statement that pros and clients always trade with each other, right? And they can trade with each other in multiple ways. Sometimes the clients are right, and clients are not to be thought about as people who have started trading yesterday. Today, when you talk in terms of clients, we include a lot of HNIs and people who have traded for about many decades, 15, 20, 30 years at a stretch, trading big sums of money in the market. So don't get into this assumption that clients do not know how to trade, or they are always trading 2 lots at a time and 3 lots at a time and are 3 days old in business. Yeah, that could be the majority case, but it's not always the 100% case. So what we see over here is just a quick assumption that pros and clients always trade with each other. Now, based on this, we enter into this chart where we are looking at exposure of the market. And to best understand this market, we have to look at it in terms of the settlement day, because the settlement day, a lot of the volume comes together, and that has to be settled by about 3:30 in the close. Right now, I'll take you back to the open of the session. This is just simply put the exposure of the market as it was looking early in the morning. Now, why do we look at this this chart over here? This tells you that who is on the short side, all this money, and who is on the long side as a net of positions. Right. So this is what is called in green buy side exposure, or net gamma, which is long, which could be long puts, long calls in the market, and this is all the money which is short. So these are your short puts and short calls. This white line over here is where the current market is trading, right? So at the open today, we had a market which was 24,500 short at this strike of 24,500. This was in the morning before open at 9:15, and we also had 24,600 which was long. So just to give you a small context to what this was, yesterday from about 12:30 or 1:30 in the afternoon, the market put in those IS30 candles and started getting aggressively on the short side. So this is the time the 24,600 PE was bought aggressively. And you would like to think of this money as naked 24,500 PE short, but it was actually 24,600 PE long with a 24,500 PE short, right? So it was a spread trade. The big money was long 24,600 PE and short 24,500 PE, which is why there wasn't a lot of panic in the 24,500 PE when we opened up first thing in the morning. In fact, the market went right up to about 24,620 futures before it started dropping down later in the market. This you can get through this chart, which is called the exposure chart, which is based on how the money is being read in the market. Now, this is infinitely better than looking at a chart of open interest, which is how the broader market tends to think of the options market. So what happens, a lot of traders, they come into the market, they look at this OI chart. And this was the OI chart at the start of the session today. And you would look at this 24,500 PE and you would think everybody is short at 24,500 PE. But the truth is, this 24,500 PE short was against a 24,600 PE long, put long. So that's why there wasn't a lot more pressure and the market was well positioned for a downside move in the market, right? The gamma exposure chart gives us a true picture such that we are not making false assumptions about what is happening in the marketplace, right? So this is okay how it is. This was in the morning at about 9 o'clock. Between 9:30 and about 10:30 morning, you can see the orange line went above the green line. So this was that time where that 24,500 CEPE straddle play started working, and in fact it deteriorated quite a lot. We were watching it as well, and it went down to, I think, a low of around 65 or 70 before the trade completely had to unwind itself. So this was the time you can say the market was short gamma. Now let me pause over here and quickly tell you what is the market thinking when it is short gamma, and what is the market thinking in terms of long gamma exposure in the market, and why we need to understand these important phases of the market. So what is a short gamma market? A short gamma market is a market which is driven completely by writers. The writer expects price to stay where it is, not to move much at all, and he profits with the market staying in one place without a lot of movement which is there. So his biggest advantage is that he thinks of the market in terms of non-directional or no vertical moves up and down, and he expects to profit from it. So that's why he will write a lot of positions thinking that the market is not going to be moving at all. And this was the case between 9:30 right up to about 10 o'clock, 10 o'clock. Also, the orange was above the green. It was a short gamma market. And right up to about 10:15, 10:30, 10:45, I think we saw that change happening. This you can say now the green curve is above the orange curve, and at this moment you can say the market is now gone long gamma. Now, what is a long gamma market? A long gamma market is a buyer of a put option. In this case, okay, the gamma high is above, is behind the price curve. So you can say, okay, these are positioned long put buyers of the market, and they're expecting a drop in the market. So this market is no longer in favor of writers. And the simple understanding to be had over here is that you do not go into this market when it is long gamma and write a straddle or a strangle, because the very fact that the market is now expecting a directional move will tell you that big money is positioned for a move to come in. So from 10:30, 10:45, since the time it went to long gamma, it was a long gamma right through the day. The green was always above the orange, except for the small part, okay, I think between hardly 5 or 10 minutes. 1:30, 1:45 later in the day, right up to the close, the market, okay, was a long gamma market. So every time, okay, you see this gamma exposure chart and it goes between that green and the orange, it is telling you, okay, that there is a chance of a move happening in the market, right? So this is what we call the gamma exposure chart. Simply put, it tells you what is the expectation of the market in terms of movement and what are the big positions in the market. If I look at this chart at 2:30 and I see this green above this orange, I definitely know that the market is not in favor of writing straddles and strangles, and I have to think in terms of buying either a call or a put, depending on how I view the market. I definitely do not want to write straddles when the market is a long gamma market. And this was the picture at 2:30. And based on this picture, the market closed higher around 24,720 futures. So that vision which the exposure chart gave us happened, okay, to come through an hour later, right? So if you see this Nifty chart, it got a lot of these IB3s, and the market, okay, went long into the close. In fact, in that last 1 hour of trade, the market, okay, moved from about 24,560 right up to about 24,720, because there was a lot of buying which was coming in via the call options. And also, okay, at the same time, it was a short covering drive and a run on call writers, which is how it worked out later into the close. So I hope, okay, this is super clear how to read, okay, the exposure and when the market is short gamma and when the market is long gamma. The assumption made that every single market has to be written and sold twice, once on the call side and once on the put side, is a fundamental reason why a lot of traders keep losing money to markets without understanding the structure, without understanding the way the market is positioned. They just keep writing left, right, and center, hoping to make money from something which is called theta, DK. But DK is not the only option Greek which moves prices. The bigger players are your delta and your gamma. And if you can understand what gamma is saying, the theta is insignificant, okay, compared to how gamma impacts price moves of options. especially on settlement day. Right. So I'll quickly pause over here. If anybody's got any questions to ask me about exposure, it's a very simple chart. Keep following the orange and keep following the buy when the market is in buy mode. Buy your puts, buy your calls. Don't do straddles, don't do strangles. Okay, this aspect I hope is super clear. We made this chart as simple as possible. What I recommend over here is a two window mode, and for you, okay, to see how this market was in the morning compared to what it is. So if you put this at 9:15 and you do not press this reset, this will show you what the market was in the morning, and you got to visualize on the right side based on how the market was positioned at the open, right? And see the change as it is happening. This shaded region which shows up in this chart is the movement of price. So every time, okay, price moved, okay, from this low of 24,349 right up to here, 24,634. This is on the spot. This shaded region shows you the movement of price, right? So it's a very simple chart and it's very intuitive in the way it explains market to you. I do hope, okay, you can put it to the best possible use and be ahead of the market, or at least be on the right side of the market in determining which trades to take in the market. So this is your gamma exposure chart, and you'll find it in the expert access. You'll find a gamma exposure for Nifty, Bank Nifty. This gamma exposure is tied to the settlement at work. So it will be different for different expiries. So we have a settlement for 14th of August. The gamma exposure for 14th is completely different from the gamma exposure for today. So you'll see, okay, the orange is above the green, and there is a lot more writing which is coming in the 14th of August expiry already, right? That's not the case for the 7th of August. The 7th of August, okay, was predominantly a long gamma market and was there right until the close, okay, where there was some puts written to even out that long short gamma, but that was just the last 5 or 10 minutes of trade. You can have a look at the monthly also, the expiry, and the monthly expiry is also showing you, okay, that there is a lot more of short gamma which is coming in the 24,500. This is still volume wise not quite over there, and it can, okay, develop as the market moves closer to this settlement. Right. So this is the gamma exposure. Use it to your advantage, and you will see, okay, that it opens up a world of opportunity for you as you trade along. I'm going to come, okay, to the second chart which we introduced, which is called the density chart, and we tried to make this chart also as simple as possible, so that there is information in the chart which you can pick up very, very clearly and cleanly and take good trades out of it. I'll strip, okay, some elements out of this chart, and we'll try to understand this chart very, very clearly. So first and foremost, let's look at what the density is. The density is the option positions of the market, both long as well as short. So all long gamma, all short gamma, all is accounted for, and the option positions where they expect to move in terms of price, that is calculated by this density chart. So the area under the density chart is where the market expects to move, where the writers and the traders would be most comfortable for settlement that day. And this particular chart is just made with one simple visualization tool, and that visualization tool is to find out where the close of the settlement would be, right? So every time, okay, you see a peak in this density chart, that is the projected close. So early in the morning, the market was projecting a close at 24,500, but volumes keep coming into the market, and the markets are very dynamic. In fact, we have a saying which says that the market is open between 9:15 to 3:30 p.m. So garden mein nahi ghumne ka. That means don't take a stroll in the park when the market is open. Be always alert, because this is a 40,000 crore industry trading crores every 5 minutes. So what happened yesterday is gone, it's history. What is happening right now is the biggest mystery, right? You have to find a way to unwind what is happening in the now. What has happened yesterday is already priced in 100% by the market. The market does not go into what it already knows. The market is always trying to price in what can happen tomorrow, what can happen later on. In case of settlement day, the market wants to know what can happen at 3:30 p.m., which is our close. So it tends to have a lot of exposure to see how which position and how and which position can benefit maximum from the positioning, from the exposure which is taken by the market participants. So in this chart, this orange curve is your density. It's showing you where the current positions are, and you'll see -1 sigma, which is at 24,400, and a +1 sigma, which is at about 24,600. So incidentally, the market went about 40 points below this 24,400 sigma today, and about 40 points, I think 30 little bit 30 points higher than this is spot prices. So just went ahead of this 24,630 by this thing. But early in the morning, you pay attention to where the market is expecting the range to be. So 24,400 and 24,600 was what was expected by market participant at 9:15 in the morning. Now this is not finite. This is the understanding of the market at 9:15, and as volumes keep coming in, as traders keep adjusting positions, as the market keeps moving, this understanding can change. But we track this and we find out what the market is thinking in terms of +1 sigmas and -1 sigma. Now this is the market expecting this to hold in 85% of the cases. So -1 sigma and +1 sigma is an 85% probability that this market works in this range. You would ask me, what about the balance 15%? The balance 15% is in these things which we call the lower tails and the higher tails. Now this is almost a 99% chance that the market is now thinking in terms of 24,150 and 24,750 being the absolute ranges which will not be transgressed or crossed today, right? So these are the tails we look at when we look at the market picture, and whatever happens, unless there is a massive event intraday, the market is pricing it between 24,150 and 24,750 because these are distinct. There is an element of a bigger risk taken, and they short this 24,400 and 24,600 to be on the side. So you would see that you will find a lot of put options being written at this lower one, and you will see a lot of call options being written at the higher one, wherever this -1 sigma is and wherever this +1 sigma is. And if you go back and look at the open interest build up today, the 24,400 was what was built today, and 24,600 call was also built, though there was a run on it at the close. But from the open, these were the two strikes which were chosen by the market to build in, as was 24,500 CE also. But like I said, today was not a short gamma market, so they chose to work at -1 sigma and +1 sigma. Now, if you are extremely conservative, you can use this information to write your strangles, 24,150 and 24,750, and this represents a 97-98% case that the market is not gonna go beyond this, right? Now, this is one aspect of the chart. The second thing which is there on this chart is what we call a convexity zone. So I'll take out the density and I'll put this convexity zone. Now, this convexity zone is got a big story to tell us in terms of how the market sees the reaction as it approaches -1 sigma and the lower tails. And this is what we call the tail concept of market profile. Tail is a place where the market does not want to trade. So it's a zone where the market feels the trade facilitation is not there. Now, the way we understand this is we look at this portion, which is here from the top against this portion, which is here on the right. And what we do is we check the skew, SKEW, and you would see that the skew on the left side is a lot more pronounced than the one on the right side. So this tells you, this convexity zone tells you, okay, what the market is thinking in terms of upside and downside. And because, okay, it is skewed this way, right at the open, the market was thinking that the chances of going down today are a lot more higher than the chances of it going down. This was at 9:15, right? And could have been, okay, anything, could have worked any day, but that's how, okay, positioning was, and that's how option pricing worked and everything else. As you go through the day, you will see, okay, that the convexity zone, okay, becomes a lot more closer. So now, okay, it is not taking in that chance lower at all, and it's become a different kind of a curve. So it just builds in a situation where it expects the market, okay, to halt. So that skew is now less pronounced at 24,300. And as the market was moving, this was around 12:15 in the afternoon, we were looking at this convexity graph and thinking, okay, that the downside is not looking as pronounced as it was in the morning. So just to show you this side by side, this is 12:15 and this is 9:15 in the morning. And see the difference, okay, between the curves. There is a lot more elongation on this left side at 9:15, and that chance of that downward move is becoming lesser by mid-afternoon. 12:15, 12:45, 1:15, 1:45. Now see the curves, right? So you're seeing, okay, a lot better skew coming on the right side. That's telling you, okay, that this market, okay, was looking to go on the long side out over here. The skew is almost gone on the left side and the right side is here. So we keep looking at this. This is through another model. If you are looking to do this, okay, for yourselves, okay, then, okay, we've got this, okay, through another model, and it tells us exactly, okay, what needs to be told, okay, about how the market is visualizing the uncertainty which is there in the market. So the lower tail is always, okay, your 3%, 97% ratio, and there is a 3% chance that the market will go beyond it. We have this concept called fat tails and left tails and long tails, etc. And I would urge you, okay, to do a little bit of thinking in those directions, and you will get an idea about how to best read these curves out over here. Now, why do we need to have this information as retail traders? Because the people who are trading alongside you, your professionals, etc., they have access to this information day in, day out. So I'm talking about your big institutions, about your hedge funds. They will not employ those crows in market without having a look at this data. They all have this data. They all look at this information, and they make decisions based on how this data changes during the day, right? So remember, this is a battleground between professionals on one side, which includes your banks, your institutions, your brokers. They also trade, and they trade, okay, with huge capital, and some seasoned traders. And on the other side is retail, individual traders, some very, very new to derivatives. And those who are very new to derivatives, because they do not have this information and they don't have real-time data to track this information, they end up being on the losing side of markets, right? So this is again the density chart. The density chart and the convexity zone go side by side, and they will tell you exactly what the market is doing at every single point in time. The convexity zone is also in a shaded region. The shaded region is the range of the day from highs to the lows in terms of spot, and it's telling you, okay, how much the market is moved and how much the market is adjusted with respect to how it was positioned at the morning. Again, for this, I urge a 2-window mode. You can put in a 2-window mode and you can look at the positioning as it happens. So left side, keep it constant at 9:15 a.m. and the right side will be dynamic. Use that reset button and it will keep updating. So what you'll be getting by keeping this in this 2-window mode would be a visualization on the right side against that adjustment which is being made by big money when they saw the market at the open. So it lets you go deep into the thought process of traders. It helps you understand how the traders have understood the market and made changes to structure as they have as the market has moved. How they have made changes to their positions also as the market has moved. Right. So this is the density chart. The density is there under expert access. It's Nifty and Bank Nifty right over here. If you want fast live streaming data on this, I would urge you to get into Elite Access because that's our feed which is coming directly from the exchange on tick data, and you will see these adjustments also happen very quickly. In Expert Access, you would get this chart, but on about a 2 or 3 minute delay. On the Elite Access, you would be getting these same charts instantly updating, ticking tick by tick, and they will calculate these positions for you real time as it happens. Right. The other tools, we have spoken about them, and maybe okay, we'll take it up again in a webinar. But this is the NTM Volex chart of today. So the purple was there right above the blue for most of the day, except that period from 2:15 when those IB3s started coming in and the call side took over. The puts started unwinding, and the calls the puts closed, the calls started unwinding, and that's how the market put in that long last legs up in the last few minutes. The order flow chart shows you the same exact piece of information, but on a settlement day, I would again urge you to go into an in the money call and track the market in terms of the delta being in your favor. So this is 24,400 CE, and the big changes which came in right around over here. We were watching that 24,500 CE, and there was an IB3 which came in the 24,500 CE somewhere just around that 215, 230 mark, where that bulk of the positioning came. So this was that IB3 which sparked that big change, and there was a run on the 24,500 call writers. 21 was the low, and if you look at this chart again, you would see that the market did not go below this 21 number for the next few bars. So that's why these IB3 levels are important, because once buyers come in, they do their best to defend their places of entry, and that's why we keep these levels as stop losses with a small filter. So you buy above the IB3 when it is crossed. So it was crossed over here, and you keep a stop loss just below the IB3, and that becomes your trade with risk defined. So it's not just about getting into a trade, it's about finding what is your risk. So this is 44 rupees, 45 rupees for entry, 20 rupees for stop loss. You're putting a 25 rupee risk at work in the market. So 45 plus 25 will give you a risk reward of 1:1, and this option gave you a lot more than that. It went up to about 96. So the Volex chart has got a large number of traders coming in. So the question, which I've just received on the chat is, can we put this in terms of numbers? We cannot put this into terms of numbers, is because this is a sum total, a cumulative total of everybody who is trading out in the market, and it's a very big dynamic number which will keep updating. The best representation of this is to wire this blue and this purple line. We'll keep it simple. If you got to see it in terms of numbers, you have to open up an order flow chart. So the minute that blue opens up above purple, You go in either through your Nifty and you will see IB3s, etc. coming. So all of this is internally built together, and the visualization technique is showing up differently in different aspects of the chart. Right. So I hope, okay, this is clear. What we've done is we built in tools which are not generally available outside. We don't want to reinvent the wheel. Whatever is known outside, everybody's using it. Let everybody use it. But what we've done is we're using weekender charts to create a different understanding about the marketplace and to work with tools which most of the other trading participants do not know of as yet. And the idea over here is to collect an edge, to give ourselves a bigger edge in our understanding of the market activity, and in terms of our tools, get better at using these tools so that we can all together trade better. Right. So I've covered gamma exposure to you with you. I've covered gamma density. This is your gamma exposure. This is your gamma density. I hope, okay, you can utilize these tools. Purely put, this is not a predictive kind of a tool. It's not a price-based tool. It's the positions of the market players, the big traders of the market, and how they adjust to market movements as the day progresses. It makes sense because we trade in the same market as them. It makes sense to track their positions as they keep trading during the day. Right. So I hope, okay, this is being useful, and I hope, okay, you can utilize this information to your best possible advantage and work with these set of tools to carve out a bigger edge for yourselves. So I'll close it off. If you have any questions, do write to us, support@weekender.com. You can DM us. You can DM my colleague Uttam. And if there's anything else okay to be added, we can do it over another webinar. Thank you all for joining in, and I'll see you okay for the next webinar. Thank you, guys.